Hello everyone. Today, we are glad to have the opportunity to share a topic that we are deeply concerned about. That is, the inflation which hit a fresh 40-year high. Inflation has put the economy under enormous pressure around the world, causing high volatility in the markets. We will walk you through the past, the present, and the future of the market under the high inflation rate. Now, let me introduce you our content. We have divided our presentation into 4 parts, from the background of the problem to effects of rising interest rate.
Before jumping into the main topic, let's go through some of the backgrounds to have an insight into the main causes of the US inflation. There are two main incidents that brought significant impact to the US as well as the global economy during the recent years. The COVID-19 was first found in December 2019 in China and started boosting in 2020. Due to the vast infection, economic activities were forced to halt for a very long period of time, which then led to the greatest recession since the 1930s. The other incident is the Russia-Ukraine war this year. Such military action of Russia was deemed as a violation of human rights. Hence, most Western countries posed sanctions toward Russia as punishment, and those sanctions imposed affected the global economy in various ways. Now, let's focus on the detail of the impact in the US. For COVID-19, on one hand, it's about the pandemic impingement that mainly affected the supply side. It disrupted the supply chain. The supply of goods weren't able to meet the strong demand caused by panic buying. Also, insufficient labor supply in markets lower the output levels. These shortages in market demand push up the prices of goods. On the other hand, the fiscal and monetary policy of the US government posed impact to the demand side as well. For fiscal policy, the US made a tremendous amount of transfer payments to both private and public sectors, giving them excess savings. As for the easy monetary policy, the US not only lowered the interest rates to nearly zero, they also continuously buying large volumes of securities, affecting various aspects. With the excess savings and such low interest rates, the demand for goods became strong, thus pushed the price up. As for the Russia-Ukraine war, importing goods such as wheat and corn from Russia or providing services like cargo deliveries were banned in many Western countries. However, banning the world's largest wheat producer or refusing to provide delivery services harms Russia and most economies as well. Shortages in supplies urge the prices of goods to rise sharply. Although there aren't direct sanctions on Russian energy, but the decrease in purchase causes Russia to decrease in produce and export of energy, hence leading a rise in oil and gas prices. Being considered as unfriendly countries to Russia, these countries had been demanded to trade in rubles, and this is a significant disadvantage in terms of the exchange rates to these countries.
Okay, let me introduce the current situation in the United States with statistical chart to you. Rate high cycle expected to start in this year to prevent bubbles as former sees current bombs as overheated. On May 4, the Federal Reserve decided to raise interest rates by 50 basis points at its meeting. This rate hike is the largest move by the US since 2000. The recent interest rate has become to around 0.83. According to the chart, the U.S. Consumer Price Index continues to climb, with an annual growth rate of 6.2% since October last year, and inflation hit a 30-year high. The record-breaking increase has sparked concerns and a surge in prices, starting to overwhelm consumers, further undermining the temporary inflation stance previously advocated by U.S. Federal Reserve Jerome Powell. U.S. monthly producer prices increased by the most in more than 12 years in March amid strong demand for goods and services, the latest sign of persistently high inflation that could compel the Federal Reserve to aggressively tighten monetary policy. The U.S. Producer Price Index rose 0.9% in February and rose 1.38% in March. Then we can expect that the PPI will keep growing in April and May. Next, let's talk about the volatility index. We can see that after the Federal Reserve decided to raise interest rate by 50 basis points at May 4, the VIX rose and became greater than 30, and it generally led to large volatility resulting from increased uncertainty, risk, and investors' fear.
After knowing the situation we just presented, now we are going to see how Fed deal with the severe inflation rate. We know that there were FOMC meetings on March 16 and May 4th, where Fed will stay there following up policy directions. First, let's see how the market predicted the policy. In March, because of the invasion of Ukraine by Russia, the market has become more risk-averse than before. Thus, market predicted that Fed would raise interest rate by 0.25%, not 0.5%. But in May, since inflation still increased, the market predicted that Fed may be more aggressive in raising interest rate by 0.5% or 0.75%. Next, if read the statement, you will find that Fed's target would be the same. Both of the targets are trying to achieve maximum employment and that inflation back to 2% in the long run. That is, fixing the high value of the inflation rate is the top priority for Fed. As for the policy in the statement in March, Fed raised the interest rate by 0.525% and say that the slowing increase in the target range will be appropriate. In May, Fed raised the interest rate by 0.5%, and what's different is that Fed is ready to shrink the table on June 1st. Now, let's see on the influence after Fed launched the meeting. We use Dow Jones Industrial Average to represent the stock market in the United States. We find that the stock price fell before the meeting in March. After the meeting, since the increase of interest rate is the same as the market's prediction, no surge or plunge were existing. And after the meeting in May, the stock market plunged in 1 week, which might be caused by the information of Fed is ready to shrink the table. The other influence we are interested in is the exchange rate market, and we find that the US dollar index has a consistent trend of rising, which confirms the theory we had learned in the class as the rise of interest will attract capital back and cause the demand of US dollar increase, which makes US dollar appreciated.
Okay, next part, I will show how does Fed's leave rate change the world. First, we know that the reason why Fed do the action this time is one to lower the inflation rate of the USA. In the expected situation, lift interest rate by 0.5% can solve the unstoppable growing of inflation, but some scholars think this maybe is a beaten trick of 1979. So what happened in 1979? The USA faced higher inflation and oil crisis. Then the chairman of Fed, Paul Volcker, increased interest rate from 10.25% to 20%. It really stopped inflation, but made negative economic growth over next 3 years. And this symptom split lot of countries because they use the same way to solve their inflation problem. Sounds familiar? That's right, because scholars think we will experience many types of leave rates frequently after this time, just like Volcker did. But this time, we have not only inflation and energy crisis by war, but also an additional variable will stress us, pandemic. And there are some countries will face bigger problems after Fed's continuous leave rates, including, first, countries export raw materials, like members in OPEC. Second, countries that depend on China's trade a lot, like South Korea. And third, countries that has lots of foreign debts and doesn't have a stable economy to hold, like Brazil. So, what about Taiwan? According to Mengdao Wu from Taiwan Institute of Economic Research, Taiwan will face more pressure on consider follow-up or keep on path. It maybe will strengthen the policy of cap rising housing price to keep money invest on other items. And the often show up leave rates decision will make Taiwan break away low rates period for at least 10 years and change industrial investment and consumption for long term.
That's all of our presentation. We hope you are a little more clear on the inflation that affect every single one of us. Thank you for your attention.